Right, good afternoon everyone. My name's Mark Whitehead. I'm Head of Global Equity Income at Martin Currie. We are part of the Legg Mason Global Asset Management Group, which manages around about 700 billion of assets globally through a number of different affiliates across the globe. I've decided to entitle my presentation today, People, Planet, Growth. Really, I start off with people because we believe that this product is a really strong one as a solution to your requirements as savers for your retirement. Planet, as we invest in companies globally, and we demand that all of our companies invest sustainably. And finally, growth, as we provide a high-quality portfolio, which we believe will be able to grow over the long term to provide you with a strong savings pot to draw out a very nice income stream, which will also grow in line with inflation when you choose to retire. I'm going to talk a little bit now about the scale of the challenge of investing for your pension. We believe it's a massive one, and it really is becoming an even more of a problematic one as we have shifting demographics or the consequences of aging. On average, every person in this room will be in retirement for 19 years. Let me just allow you to just have that sink in a little bit. So 19 years in retirement, for which most of us in this room will only have saved for 7 years of that retirement. We will therefore have to put up with either a lower standard of living when we come on to retire, or we'll have to live off capital that we've saved and pass little on to our children. Or we'll find that we must simply just work a lot longer, way past the UK retirement age of 60 or 65, and perhaps even full or part-time well into that 19 years, which we call the greying zone or the grey zone. As an asset allocator helping to build bespoke portfolios throughout my career and for private individuals in the early part of my career, and of course as someone who's saving for my retirement, I understand this problem acutely. Gone are the days that we should follow traditional asset allocation theory, which tells us that we should be investing 50% of our portfolios with quite a way to retirement into bonds. We believe that we need to be investing much more in global equities to drive wealth creation. Equity income should form a core part of that investment, allowing the saver to benefit not only from the powerful forces of compounding where the dividend can be reinvested, but also use that dividend to draw down and obviously live off it when we get to retirement. Because it may be such a long retirement, the phase out of equities into lower risk asset classes such as bonds should actually be much more gradual in our view than the textbooks have us following at present. And when some of the income is required in the grey zone, equity income is the perfect asset class to provide an inflation-protected income stream as well as the opportunity for capital growth. So we see your challenge as an exciting opportunity to provide a solution that is relevant to your essential needs. We offer capital growth from our portfolio with a high-quality portfolio that will generate high and real income streams to compound or withdraw to suit your needs over time. Over the last 5 years, global equities have outperformed other asset classes one could have invested in, and we expect this to continue. £20,000 invested 5 years ago in global or other asset classes, you can see here on the chart, has actually produced nearly a £35,000 return by investing globally rather than investing in the FTSE All-Share or UK equities alone. So a much better return than other asset classes from investing globally. And investing in a UK passive product would have only returned £26,000, which is just shy of £9,000 less. So that's a massive difference, and we really believe that's just not a one-off. So I need not to make any assumptions about the likely Brexit outturn, as it's so unclear, but single country risk must be diversified, and a global portfolio should provide investors with a much better return. So we believe this is just not a one-off occurrence. As I mentioned, over the long term, more often than not, equities outperform bonds. And so if we're investing for 19 years in retirement, and that retirement is 5, 10, 15 to 20 years away, we should definitely be investing more of our portfolios in equities. So when we come to retire, we can also use those dividends to protect against the cost of living on the chart on the right-hand side, which will be rising through the dividend growth that we'll receive from that portfolio. Coupons from bonds simply will not be able to provide that for you when you reach that retirement. So why do we advocate a global equity approach? Well, the UK market is a very concentrated one for investors. Over 60% of the total income that is produced from the FTSE All-Share is produced by just 20 companies. In fact, actually 10 companies produce over 50% of that income stream. And many of these companies are very cyclical in their nature, and at times do not cover their dividends by earnings, let alone the free cash flow that they're producing for their portfolios, their businesses. So just think of some of those names: BHP Billiton, Rio Tinto, Royal Dutch Shell, BP. All of these companies can and will cut their dividends at certain times in the economic cycle. And it's really important to guard against that. With a global portfolio, we can find companies at the bottom of the cost curve that should be able to generate better dividends, grow those dividends faster, and produce better total returns through the investment cycle. So just remember that large liquid bellwether stocks can easily disappoint, just as BHP Billiton did in 2015, when they actually cut the dividend almost to zero, so a very aggressive cut, and the company lost a lot of capital as it went into that eventual cut at the end of 2015. What's more, if you have a global approach, you are able to benefit from other exposures that you cannot get through a UK-only portfolio. And you can see that here in terms of technology, which of course has been driving market returns for the last 3 to 4 years. Now, that doesn't mean that we're invested in lots of FANG stocks, which of course are not doing so well of late. But it does mean we can invest in some really nascent technologies through some very strong large cap companies that will generate good returns in your portfolios. The reality for me as an investor is that we can find the best structural growth stocks in all forms all over the planet, not just in particular regions such as the UK. We therefore insist in all of our companies have long-term secular growth drivers, these being the best growth that is defined as persisting over an indefinitely long period. And it acts as a tailwind. It enables our companies to be able to grow the top line of their businesses consistently, knowing that they are going to be able to invest to garner sales across the globe that will be consistent, and that will grow their earnings over the long term. Just look at some of the stocks we're invested in today. We have exposure to nascent technologies such as artificial intelligence, cloud computing, and even quantum computing through the likes of Microsoft. But there are many other long-term trends that we believe will drive strong shareholder returns across the globe that we can find. We have a universe of over 3,000 stocks that we can choose from. So we're not just having to choose 10 or 15 or 20 of those stocks that other UK funds have to look at. We don't just look for trends that may drive revenue growth. We look for companies that can also consistently grow their earnings and cash flows to drive sustainable dividend growth and returns. And we believe that high-quality companies are the best companies to look for because they are the best place to be able to provide that consistent growth. So we look for very strong companies that can produce high shareholder returns, return on invested capital, which is above the cost of capital when they come to invest. We operate a robust, repeatable and transparent investment system, which we like to think delivers an institutional standard portfolio. There is no black box to what we are doing. We also employ some processes that are a part of our investment system, which we believe goes a little bit further, if not a long way further, than other managers care to undertake themselves. Sustainability is something that is absolutely key, and so we spend a lot of time looking at the balance sheet of all of the companies that we invest in, stress testing those to make sure that our companies can continue to pay the dividend throughout the economic cycle. Our companies must operate the correct balance sheets for the businesses that they operate, allowing them the autonomy to invest and grow when perhaps other companies cannot. Credit analysis and rigorous stress testing are used to build scenarios to enable us to assess the risks to the cash flows and thus the dividend through the economic cycle. And armed with this information, we can then engage with company management to get them off talking about earnings that they produced perhaps over the last few months, over the last quarter or so, and really start to think about the risk mitigation that they have in their businesses and what they will prioritize in terms of their capital allocations. These processes have been honed over the past 20 years that I've been doing this job, and I've never put through a dividend cut to any of the shareholders or investors in the products that I manage. We care very much also about ESG investing, environmental, sustainable and governance processes weaved into our active management of the portfolio. That's because companies that do well on ESG practices generally tend to outperform over the long term, because they generate strong and sustainable cash flows that are able to be replicated and aligned with stakeholders through the production of a dividend. We are not just paying lip service to this, and there's a lot talked about it in the industry at the moment. We have got a top decile score from the PRI, the Principles of Responsible Investment, for our practices. So here's an example of a stock that we're invested in at the moment, the Dutch company DSM. It produces vitamin supplements and nutrition solutions for humans and animals and sits in our dietary change trend theme. It also produces performance plastics, which use similar chemical processes to the production processes used for vitamins, God forbid. But whether it's the structural need to eat more healthily, to tackle obesity, the requirement to grow protein faster and more efficiently to use resources more sparingly, or the need to produce high-performance plastics for cars so they burn less fuel, these are undeniably all very pervasive trends. DSM have industry-leading ESG credentials, but I hear you say, so what? Well, amongst other things, they are reducing their carbon footprint. They recently secured from a syndicate of banks some debt, long-term debt, which has a coupon linked to the cost of that debt, the cost of that debt to carbon emissions. So if they reduce their carbon emissions to predetermined levels over the next 5 years, they will have to pay less in terms of those coupons, and that leads to better profitability for the business. Because of their ESG footprint, they are routinely asked to be preferred suppliers to their clients also, strengthening their order book. So strong ESG practices are simply good for business. The company, they also provide a number of different and very interesting products into some other sustainable projects. They have just produced a nylon towing rope, which is 15 times stronger than steel, which has just been deployed to the Great Pacific Garbage Patch as part of the Ocean Cleanup Initiative. So DSM is a high-quality company, providing a combination of strong growth and dividends to shareholders. So our portfolio is diversified by stock position, sector, and region. We are active managers with a high active share, which means we have a bottom-up approach and make sure that we really understand the companies we invest in. Unusually, our largest position for a high dividend yield fund is a tech stock, and that is Microsoft today. But we have 6 out of the 11 sectors across the globe that are represented in the top 10 of the portfolio. And you'll see that we have nearly 40% of the portfolio invested in the top 10 stocks. So this is a high conviction portfolio. We hold less interest rate sensitive bond proxies, which have not been working as interest rates have been rising, particularly in the US. In fact, actually, we believe our portfolio should continue to perform well in that type of environment because our stocks are growing. They are not value traps. Every single one of the companies that we invest in is investing themselves for future growth to drive strong dividend growth in the future. We have a low weighting in the UK, again, a differentiator versus our wider peer group. Just because the UK market is obviously a high-yielding one, we think that we can actually produce enough yield from a global portfolio with greater diversification, which is a differentiator to our competition. This makes us a great complement to some of the other portfolios you've heard about today. We offer today a one-year forecast yield of 3.8%, which is very, very similar to the FTSE All-Share, but from a globally diverse portfolio. The Board of Securities Trust evaluate Martin Currie's performance versus a bespoke benchmark, and you can see that on the left-hand side in terms of the return that we've made so far since I started managing this portfolio in May 2016. We use a benchmark which includes all of the open-ended global peer group, but also the closed-ended peer group. And that is by design to reflect the choice that you have when deciding to invest in a global equity income fund. As I mentioned, the total NAV return, net asset value return for the fund, since I started managing this in May 16 has been 30%, while also providing a top quartile dividend yield. And we have grown the distribution to shareholders by 24% since 2015. And we believe that we will be able to continue to grow the dividend, and the board has a progressive dividend policy to enable us to do just that. The 24% growth is, of course, way ahead of UK inflation, and that is exactly what we want to do. That's part of our objective, to produce this long-term dividend growth to protect your spending power. So we believe our equity income fund is a solution for the whole of the saver's life cycle. Accumulation towards your retirement should be absolutely the first and foremost objective of our fund. And then when you come to retire, the inflation proofing of the income stream in your retirement is absolutely paramount too. And because you're going to be spending longer than average than perhaps 20, 30 years ago that one might have thought, 19 years perhaps in retirement, your capital must suffice so that you can draw down the income stream from it. Our solution is a global approach to equity income, an aim to deliver a rising income and capital growth throughout that period. And we demand that our companies do it on a sustainable basis. Our differentiators are that we are a high-quality portfolio that we believe will continue to generate strong shareholder returns. We are highly convicted, and it's based on Martin Currie's specialist equity research processes. And of course, we will produce that inflation-protected dividend stream. I'd like to thank you very much, ladies and gentlemen, for listening to my talk. Please do feel free to come and ask me questions in the interval. And we have some goodies to give away, hopefully, on our table there. Thank you very much.